partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast. Marcus, Chip Nellinger. This edition of the Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years. If you want to get a free beanie, send an email to just send it to marketing@axontire.com and they will get that over to you ASAP. Also, if you want $50 off the registration for the Moving Iron Summit, send me an email at MovingIronPodcast@MovingIronPodcast.com or just go and sign up on the website at MovingIronLLC.com and they'll get that taken care of. So the first 150 people that sign up for the Moving Iron Summit get a $50 discount. So check that out. Valley Transportation and hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours. And no matter how you buy your ag equipment, whether it's from a dealer, an auction, or a private party, AgDirect can help you finance it. You can even apply online at agdirect.com. Learn more about your financing options at agdirect.com. Tractor Zoom has access to over $20 billion in heavy equipment sales data. Tractor Zoom's Iron Comps is the industry's trusted solution for transparent equipment values and optimal pricing insights. This podcast is also brought to you by Anvil AppWorks. Their Dealer Connect CRMI app with integrated inventory management is an affordable Salesforce-based solution for your dealership. Check out your connected customer experience and transform how you work today. Wow, that was a mouthful there, Chip. Chip is
Casey, it's pretty early for that, man. That was a mouthful.
Yes, it was. So Chip is with Blue Reef Agri Marketing out of Morton, Illinois, and he's nice enough to come on and talk about what's happening in the marketplace. So Chip, how you doing, buddy?
Doing well, Casey. I think this is the first of the new year. It's been a little bit since we've talked. So happy New Year.
Yeah, you too, man. It's been bouncing back and forth on schedules and stuff going on. So pretty busy start to the year. Seems like, well, on my end of the business, on the equipment side of the business, we've seen one of the best starts to years in a long time. But there's still just a tremendous amount of volatility. Not so much, well, I mean, there's price volatility out there, but there's still that kind of lingering unknown out there, Chip. So I guess this first of the year, kind of what are some of the feelings you're getting from your customers out there right now?
Yeah, I think that we really have to keep a close eye and recalibrate, our psychology a little bit. In my opinion, the market of the last 3 years basically has gotten people out of their normal marketing habits. It's kind of trick people into thinking. You mentioned the volatility, right? We've seen some massive volatility. We've seen, I can't even tell you, $10, $12, $1.50 to $2 price breaks in beans over the last 2 or 3 years. But every time it comes back and almost gets back to the previous highs. We're, in the midst of that right now here to start the new year off. We had a big rally in beans, and it's kind of got people in the mindset that, okay, prices are breaking, whatever it is, it's China, it's COVID, it's whatever the excuse is, just wait a couple months and we'll get another crack at it. And that has been the case for 3 straight years. But I think that's a dangerous mindset to be in. I'm sensing a lot of, I don't know, apathy. I don't know if apathy is the right word. The other thing that tricks us psychologically, we've spent a lot of time the last 2 years seeing and selling corn north of $7. And, you know, in fact, right now, depending on where you're at in the country and what your basis is, you know, we're very close to or just slightly north of $7 on cash corn. But then you look out ahead of us and say, oh, like new crop December futures at 598, you know, I'm not interested in that. So I think it's just a dangerous precedent because we're so razor thin on, you know, the carryouts across the world that, you know, we do have the potential to go a lot higher, but you know, it's almost going to be an if then proposition. You know, we're going to hit a certain point here. We're either going to have a big second crop corn crop out of Brazil and then a big crop here, and we won't need to be at $6 any longer. And so I think it's just dangerous, you know, as we look out into the new crop. I think the psychology of risk management and marketing, you know, the market's done a really good job of lulling everybody to sleep, and I think that's a dangerous spot to be in. I think myself included, I think we all need to kind of resharpen the saw and refocus and zero back in, because one of these days prices will break and they won't come back. And it's been a long time since we've seen that happen. And you know, I'm fearful that it could be the case, you know, if we're not careful in 2023. And you know, there's profitability. That's the thing. If you crunch out where you're at with costs and where current new crop price levels are, there's some profitability there. But
Right.
you know, corn breaks 60 cents and beans break $1, you know, then there's no options. The option then is sit and wait and hope that prices come back. So, you know, I think if there's anything in this new year that we should all be maybe getting refocused and sharpening the pencil a little bit and kind of thinking about the market psychology, I think that's kind of lulled everybody to sleep the last 3 years with a big bull market.
Yep. Let's talk about wheat for just a minute. As you look what's going on around the world, you got the Russia-Ukraine war. It's still putting pressure on the wheat market. You know, there's been reports out of Ukraine about, you know, if everything stopped today, it would take, you know, at least one cropping cycle to get things back to normal, which, and they've lost 50% of their acres right now. So there's that pinch that's out there. Yeah. India is doing all they can do to keep the price of domestic wheat down. So wheat supplies around the world obviously slow, but we can rebound pretty quick. But you look what's going on in the United States, and the odds of the United States having a massive bumper crop just based on what we saw from this fall and the winter kill stuff we've seen doesn't look all that promising that there's going to be a massive crop coming out of the United States. So I guess looking at drought situations in Argentina too, also putting all kinds of pressure on that. So looking at the wheat market shift, what are your thoughts there?
Yeah, you know, it's a real head scratcher given all the problems that you mentioned. Ukraine, you know, drought in the plains, you know, one of the poorest rated wheat crops here in the United States in history so far as we went into dormancy. But yet, you know, we've just seen a massive price break in wheat. The funds are short. You know, it just seems like in spite of problems in Ukraine and a problem here, the world can do a very good job of raising wheat. And, you know, to counter some of that, Russia appears to have had a massive crop, even though there's sanctions on them. Some of that wheat is getting out into the world market. You mentioned India, you know, that they seem to kind of be like China in that you can't really, you know, put too much stock into what their crop projections are. You know, sometimes they put some weird numbers out there, but you know, in spite of that, they seem to be doing okay. Australia, you know, had all kinds of problems and, you know, too much rain. And all of a sudden, when it's all said and done, Australia has a much bigger crop than what people expected. Maybe the quality's not quite what it normally is out of Australia because of the rain, but there's still a lot of bushels there. And so, you know, right now, I think the market has a lot of bearishness factored in. The funds aren't record short, but, you know, they're a pretty healthy short position. I think probably right up around 60,000 contracts. That report, the USDA report a week ago, you know, threw a much higher acreage number in than the market was expecting. And we, I think the thing that might be happening is we stopped going lower on bearish news. And so maybe everyone that wanted to sell this this wheat market has sold it. The funds are loaded up short. We may be at a pretty healthy price level here, a fair price level for the time being. Could easily see, 60 to 80 cent rallies just on short covering. But to me, it looks like there's just a massive amount of bearishness factored into the wheat market right now. I think the next shoe to drop is going to be once we get a little later, early spring, and you get some of this crop out of dormancy in the plains. Then it's going to be refocused on, okay, what is the production potential out of Kansas and Oklahoma and Texas? And, I'm not sure that there was enough moisture around to miraculously take that from the worst rated crop ever to a bumper crop. And so I think the market still has to kind of deal with that out ahead of us at some point, and could easily see, a bounce here into spring, in my opinion, in the wheat market. And I think wheat can kind of divorce itself a little bit from what's going to happen in corn and beans, to some extent. But it just seemed to struggle. The world does a good job of raising wheat, and I know there's been pockets of problems here and there, over the last 2 or 3 years, but it just still seems like there's, no shortage of wheat in the world, and crops have ended up to be just a little bit bigger than expected. And I think that big Russian wheat crop maybe was, the final straw that kind of, caused the most recent, 60 or 80 cent price break in the wheat market.
Yeah. Okay. Let's jump down and talk about what's going on over in the well, first let's do this. So let's look at like ethanol and biodiesel and crush rates, all those kind of things you see happen right now. Big push right now for in 23. We're going to see an even bigger push in biodiesel and what that looks like and how that's going to affect our overall soybean market. Just I can look at ethanol and where gasoline is compared to where it's come down to. I think the last time I looked today, I think gasoline's trading like 260 something right now. I guess looking at ethanol, biodiesel, all those things that come into play with, especially when you start looking at crush. What are your thoughts there? And if they continue with this biodiesel thing, how many acres of corn is going to go to soybeans to get this crush rate thing we're looking for?
Yeah, that's going to be some moving gears that the market has to adjust to over the coming year or two. I think part of that puzzle may be solved potentially with a big bean crop out of Brazil. They're at the very early stages of harvest down there. I know Argentina's got a serious problem, but net, the Southern Hemisphere bean crop is going to be way bigger than a year ago, and a record crop out of Brazil. And so that is part of the puzzle, right? Because we've gained so much on the export side on beans in the last 2 years because of back-to-back droughts in the Southern Hemisphere. And now if you return to some more normal crop sizes this year and next year in the Southern Hemisphere, they're going to take back some of that export business, Brazil is. And so that loosens up a little bit, that our exports will come down at the same time we're ramping up the demand on the biodiesel side. And so there may be enough room in the balance sheet that, there's no severe tightness or need for, 3-4 million more acres of beans. But what it does mean is it's just that much more important that we continue to raise big crops. And, I think there will be somewhat of an acreage battle as you get, from now into spring. I think there's a lot of acres that still are undecided. They could swing one way or the other. We've got, essentially record high input costs. There are some signs that some fertilizer products are starting to come down. And so I think this battle between corn and beans going into this spring is going to be very real as well. We just haven't seemed to spend much time north of $6 on December corn futures. And, I'm not sure that price level secures an extra 2 or 3 million corn acres like the market is starting to believe. And so it all plays in there. The energy side has had a big setback, from $110 crude oil and, now well under 80. We've started to rally back a little bit. There's, some talk that once China comes back from Chinese New Year here in the month of February, that, now that they've opened up after COVID, that there's going to be this huge push of demand and, get the energy markets fired back up. That remains to be seen, but that all plays into the profitability of that sector as well. So, I think it's a good thing. I think, I feel like I've been rambling for 10 minutes now on your one question, Casey, but I think it all comes down to the size of this Brazil crop, how much competitiveness they're going to have in the world market as far as exports. If they take back some of that market share that we've gained the last 2 years, particularly out of China and Chinese exports, Chinese imports of U.S. beans, I should say, then, we may be happy that we do have this extra demand, because it could be pretty severe. Just to put it in perspective, I mean, the most recent estimate, 152-ish million metric ton crop. They're getting some rain in some of the southern areas that could add some bushels. There's some people thinking that could still approach 154, 155 million tons in Brazil. Yeah, that's like a 5.6, 5.7 billion bushel bean crop. That is just massive. 1.2 billion to 1.4 billion bushels, billion with a B, bigger than what we produce here. That is a lot of bushels that we're going to have to deal with out of Brazil. Yes, there's a shortfall in Argentina. Some of those beans are going to go to Argentina to run their crush capacity, but that is an awful lot of beans that I'm a little bit fearful of. And it's just going to, we're just in the process of starting that harvest. So those beans are going to be hitting the market here over the next 6 or 8 weeks.
Right on. Okay. We are seeing some slowing in the economy here in the United States. We've talked about that. We've seen that throughout last year, and we've watched the price of meat at the grocery stores still stay fairly high. You start looking to see what things are. You start looking at the price of beef, especially the prime cuts of meat that are out there, and you're still paying $17, $18 a pound for ribeye steak and those kind of things. So you're looking at there, you're seeing some pretty good volatility in those marketplaces. But as the Chinese market, like you said, kind of starts to open back up, and we start seeing more, we're seeing more shipments of U.S. hogs over to China than we've seen over probably the last couple of months anyway. But I guess, so Chip, looking at the protein markets right now, your thoughts there, and can we see, you anticipate seeing these prices stay where they're at this first quarter of 23?
Yeah, there's, again, a lot of moving parts there. I think one thing that's been holding us up have been just tremendous exports on both pork and beef. A lot of that driven by China, especially on the pork side. They all of a sudden have apparently, fixed their health problems in their hog herd, and in fact have this massive overcapacity now. And you've seen our hog market take a big hit as a result. Our beef, our cattle numbers are shrinking. We got a cattle on feed report this afternoon, and so we'll get an update on some of those numbers. But it appears that after 2+ years of breeding stock liquidation due to the drought, that our numbers are starting to shrink. Our weights are coming down. That is a good thing, because unfortunately, we're putting some pressure on the consumer due to inflation and higher prices. We're starting to hit the export market a little bit. 1 week here or there of poor numbers on exports, on the protein side is allowable, but it's been several weeks, where it was going into the holidays, and now after the holidays, we just can't seem to get much traction there. So that might be a big headwind here. We're going to kind of cut back on our export side if the consumer does start, paring back a little bit and not buying, $18 steaks, $18 a pound steaks and up, then this domestic beef demand could struggle a little bit too. And pork prices have come, down pretty dramatically over the last month and a half. So it's not all bright out there, and you still have relatively high feed cost. You have high soy meal costs right now. Corn's out here $7 roughly in the central part of the United States, probably still 8+ in the plains. And so, it's not all rosy out there, especially on the livestock sector. And there's, in spite of, the cattle cycle starting to take hold here in lower numbers, that might be a good thing, because unfortunately the demand side looks a little bit suspect here as we, get deeper into the first quarter in here. And so hopefully we can hold things together and not too much, put too much more pressure on the consumer. You mentioned earlier, the energy market. I think these lower gas prices relative to 6 or 8 months ago, that's almost like a pay raise to some extent. Instead of, it's nice. Instead of spending $90 to fill your tank, you're spending 60. So you got some extra money in your pocket. And I think that's been a good thing, and maybe, helped hold the consumer together a little better than, if we still had $5 gasoline.
Right on. Okay. All right. Good stuff as usual, Chip. Folks can reach out to you and get more information about what it is you're doing at Blue Reef Agri-Marketing. What's the best way to do that?
Yeah, best way is just call our office, 309-550-7213. We'd love to chat with you. We hit on it earlier. I think it's going to be one of the more important and gut-wrenching and maybe one of the hardest, marketing years, risk management-wise, that we've seen in a long, long time in 2023. So it's more important than ever to have a plan, execute it, and, pay attention to your bottom line.
Yep, I would agree with you. All right, Chip, appreciate you being on the podcast, man.
Hey, thanks for having me on, Casey.
All right, man. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC, LinkedIn at Moving Iron Podcast, and check out the video version of this over at the Moving Iron Podcast YouTube channel, which is called the Moving Iron Podcast YouTube channel. So check that out. More information about the Moving Iron Summit, go to MovingIronLLC.com. Go to and check out the registration page there. Speaker information will be up here directly. So check that out when you have some time. Or if you have any questions, email me at MovingIronPodcast@MovingIronPodcast.com, and I'll make sure to get those answered. So with that, I'm Casey Seymour with Chip Nellinger. Smooth Smart folks. Out.
Moving iron in the 21st century. Hard work